You're at the closing table. Your hand is cramping from signing a mountain of legal documents. The real estate agent is checking their watch, and your lender slides one final piece of paper across the desk. It's an offer for mortgage life insurance. They frame it as a simple way to protect your family. If the worst happens to you, the house is paid off. In that moment of exhaustion, checking the box feels like the responsible thing to do. But that single pen stroke is quietly one of the most expensive and inefficient financial mistakes you can make. The issue comes down to who actually benefits. Creditor and mortgage insurance products are built from the ground up to protect the financial institution that issued your loan, not you or your dependents. By choosing the convenience of the signing desk, you are actively paying high premiums for a product that leaves your family financially exposed right when they need the most support. Let's run the numbers on how this actually works. Take a hypothetical healthy 40-year-old couple signing for a new $660,000 mortgage. If they accept the bank's mortgage life insurance policy, they will be charged around $198 every single month. This chart shows the first major mechanical flaw of the product. The blue line represents your insurance coverage, which actively shrinks as you pay down the principal on your home. The red line is your $198 premium. Notice how it stays completely flat, meaning you are paying the exact same price for significantly less coverage every year. Then there is the payout itself. If one partner passes away, the death benefit doesn't go to the surviving family to help them cover living expenses. The money is routed directly to the lender to clear the debt. And that payout isn't even guaranteed, thanks to a practice known in the industry as post-claim underwriting. This means the insurance company only investigates your medical history after a death occurs, instead of when you sign the paperwork. If the reviewers dig through your records and find a minor, unflagged pre-existing condition, the claim is entirely denied. The bank gets nothing, and your family gets nothing. You end up holding a depreciating asset that you severely overpay for, providing only a very conditional illusion of security. Let's rewind the clock and look at the alternative path. What happens if this exact same couple declines the bank's offer and applies for an independent term life insurance policy? A standard 20-year term policy covering the full $660,000 for each partner individually prices out at a combined total of only $98 a month. Because independent insurers use upfront underwriting, verifying your health status before they ever issue the policy, the terms are locked in. The payout is structurally guaranteed. You also secure what is called level coverage. The $660,000 death benefit is completely detached from your mortgage balance, so the coverage amount never shrinks. And if the absolute worst-case scenario occurs and both partners pass away, the policy pays out a combined $1.32 million, tax-free, directly to your dependents. They can use that cash to pay off the house, fund a college education, or cover daily living expenses. By simply moving the transaction away from the mortgage desk, you secure more than double the total coverage for half the monthly cost, all with the certainty that the check will clear. There is one specific scenario where the bank's offer makes sense. Creditor insurance might be a necessary option if you have severe pre-existing health conditions. Because they delay the medical review until after a claim is filed, bank policies generally have much higher initial acceptance rates for individuals who would otherwise face unaffordable premiums or be denied outright on the open market. But for the vast majority of healthy homebuyers, there is a final hidden lock-in trap. Mortgage insurance is permanently tied to the specific loan contract. If you decide to switch lenders to get a better rate, or if you refinance your home down the road, your insurance policy is immediately canceled. You are forced to start over and requalify for a new policy at an older age, which guarantees higher monthly premiums. You shouldn't pay a premium to protect your bank's bottom line. By keeping your life insurance entirely independent from your debt, you build a financial safety net that actually catches your family.